Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report. We're going to be discussing headline inflation, core inflation. We're going to discuss the impacts of this report on interest rate projections by the Federal Reserve and discuss whether their strategy here is effective in bringing inflation down or if there's a risk to the upside. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. Let's go ahead and jump in. Inflation is a very important thing to follow. The markets are often reactionary towards it. If you were to look at the 1970s, you'll find examples where the market tops out, right? The market tops out as inflation is accelerating. And oftentimes it'll bottom out as inflation is topping, right? You can see it over here again, right? Inflation topped out, the market bottomed, but inflation right here, as it reaccelerates, inflation tops. And so back in the 70s, they went through this period of like stop and go, where basically they would go to looser monetary policy, to tighter monetary policy, back and forth until we got an inflationary decade. And they were unwilling to do what needed to be done to get inflation durably back to their 2% objective. Inflation headline inflation today came in at 3.1%, which is marginally lower. I mean, you can see last month it was at 3.2% or so. So it came in a little bit lower. So at least some progress was made, right? But one of the most difficult challenges for the Fed is that last percent, right? It's never that hard historically, as long as they raise rates, right? It's never that hard to get inflation back down to around 3%. What's the hardest part is that last percent, to go from 3% to 2%. And we can learn something from the mistakes of the 1970s. If you go to the grocery store today and you get, your normal groceries, you're probably used to spending a certain amount up until the last couple of years, but then now you go and you're probably spending 50% more than you used to, just because everything has gone up so much, right? Now think about how painful that is to, how much more expensive everything is. That's one peak. That's one inflationary wave that led to that pain. Now think about the 70s and what they went through back then. And 3 peaks of inflation, right? 3 separate waves of inflation. It's one of the reasons why, like, when people who were born back in the the 50s and the 60s, they will say things like, things used to be so much cheaper, right? Well, we're going to be saying the same thing, right? In 30 years, we'll be talking about how much cheaper things used to be. Imagine what they went through, though, right? 3 peaks of inflation. That's why things were so much more expensive today than they were back then. Now we're kind of getting a glimpse of what they went through back then with at least this first major wave in inflation. I will mention there is a caveat to the CPI calculation. The way they calculated inflation back in the 70s is actually different than it is today. And I'm not suggesting that they're doing it for some nefarious reason. I think they're just trying to figure out the best way to calculate it. The problem, of course, is that it makes it difficult to compare, right? You're not really comparing apples to apples. You're comparing 2 different methodologies. Imagine if you were a researcher carrying out some type of experiment, and to calculate a certain set of data, you use one methodology, and then to get other data, you use a second methodology. It would not make sense to then combine those data sets into a single data set if the methodology used to obtain them was different. But that's essentially what we're doing when we look at inflation year over year, because we always look at what these, the trends over here. But remember, these trends were based on a different calculation than they are today. I went through a little back of the envelope calculation to figure out what this would have been had they calculated it out using the methodology back over here. And it turns out we would have gone higher, right? I mean, inflation sort of topped out around 9% year over year. I think it would have gone a little bit closer to this peak in 1974 had they calculated it in the same way. So just be aware that these peaks over here can look quite daunting, but they're actually not that dissimilar from what we just experienced. It's just that the method to calculate them was different. So what can we learn from the 70s? And why has Powell said so many times that they want to avoid those mistakes? Okay, let's take a look. So there's this decade right here, and you can see that from 1970 to 1980, we essentially had 4 recessions, which is crazy to think about because when you think about today and the current age, we haven't really had a recession in a long time. Yes, there was the pandemic, but if we exclude that, and I think it's reasonable to exclude it, I'm not trying to pretend like it didn't exist, it does. It's just that it's not the typical business cycle that you get, right? Like it's not the typical cycle where it takes years and years and years to play out that ultimately leads to a recession that then lasts for several quarters, right? If you look at this period over here where there were 4 recessions, what do you notice? You'll see periods where inflation went up. Here it went up to about 6.5%. Remember, the calculation was different back then. And then it came back down to about 3%, which, by the way, is where we are today, right? We're about at around that 3% level. And back then, the Fed was unwilling to do what they needed to do to get inflation durably back to 2%, right? And what happened is we saw inflation re-accelerate, right? It re-accelerated back up. Now, interestingly enough, there are some similarities, right? I mean, if you look at when the market topped out, it topped out, December, January December of 68. It then found this bottom in I guess June of 19 or May of 1970. But then it re-accelerated, right? You can see that as inflation came down, the market went up, right? The market went up as inflation came down. But the market topped out as inflation started to re-accelerate. Why did the market top out? Well, you have to remember, like right now, the market is expecting rate cuts next year. Market's expecting rate cuts in 2024, starting by May. And some people are betting, I mean, there's at least one person betting on it's going to start in January. It's probably a bit too soon. There's a reasonable chance that occurs in March. But consensus right now is that rate cuts start by May. The question is does that represent higher for longer with what the Fed meant? And is that, if they were to start cutting in May, would that be sufficient to bring inflation durably back to their target? Remember, if they cut prematurely, we run the risk of inflation re-accelerating like we saw in the 1970s. And if you look at the market, this is the S&P 500, you can see the market, it actually put in a higher high, but it topped out as inflation was starting to re-accelerate, right? As it got back to 3.6, 3.8, before it got back to 4%, the market was already starting to trend back down because it recognized that tighter monetary policy was on the way. And then you can see again that the market bottomed out in 1974 as inflation peaked again. And then yet again, after it peaked, inflation came back down to 5%, and then it re-accelerated again. Now this time when it re-accelerated, the S&P did not even go put in a new low. But bear in mind, it had just gone through a decade of lower lows and lower highs, right? So in 1966, we had a low, then we had a high, then we had a lower low, and then a higher high, and then a lower low. And then so finally, we did get another inflationary wave, but it did not correspond to the S&P going to lower lows. It did correspond to some recessions where people were getting laid off, but it did not correspond to the S&P putting in a lower low after we got out of that decade of higher highs and lower lows. But it shows you that if the Fed raises rates, they can bring inflation down. The hardest part is getting back to 2%. And you can see that back over here, they weren't even able to get back to 2% until we actually got 2 back-to-back recessions. I think they finally threw in the towel, and Volcker, he did what needed to be done to get inflation durably back down to the 2% target. So this is what we want to avoid. This is what Powell has said that they want to avoid. The reason is if inflation starts to reaccelerate, the market's probably not going to like that. I mean, in the short term, it can always go up, right? I mean, it even started to go up over here. It even put in new highs. The problem is if it starts to go back up, in another inflationary cycle, another inflationary wave, the market is generally not going to like that. Now, you have some examples, right? Some of which the market put in a lower low, some of which it basically just didn't go anywhere for a long time. I mean, if you look at this, it sort of went up to this plateau in 1976 and was still basically at that level 4 years later. Okay, so that would be a very boring market, to be in, to basically just be flat for many years. And really, it was flat for a lot longer than that. If you consider that back in 1968, the S&P was at 100. It's kind of weird to say that, right? At 100 when today it's at 4,600. But it was at 100 back in 1968. It was at that same level in April of 1980. 12 years later, after this entire inflationary decade. And they made a lot of mistakes back then. As you can see, right? Inflation went up and then it came down, and then it went up and down, and then up and then down. And it was just a game of chicken, basically. The Fed's going to cut. We're going to go back to looser monetary policy. Oh, they didn't do their job. We exploded. Inflation exploded back up to the upside. So today, we're kind of in a similar spot where headline has bottomed out locally around 3%. The question being is, will the Fed do what needs to be done to get it durably back to 2%? And we'll find that answer out, I guess, in 2024. We will find it out in 2024. Because if they don't do what needs to be done, then the market might have to start pricing in more rate hikes later on if inflation were to go back up. I mean, if inflation were to start trending back up to 4% or 5%, do you really think the Fed's going to cut? Probably not. So what that means is the Fed needs to stay higher for as long as they can to sort of break this down to 2%. If you want to know what I think, which, by the way, just for the record, I often get things wrong, right? So let's be clear about that. But if you want to know what I think that they will do what needs to be done, but it's really hard knowing the timeline on that. I don't really think they're just going to let inflation run back up to 7, 8, 9%. I think that they would continue to hike if they need to, but there is evidence already that in many sectors, inflation is starting to come back down, right? We are getting disinflation. Remember, though, there is a difference between deflation and disinflation. Disinflation is a good thing because it means that we're going back down to where we need to be. Deflation, while I know a lot of people would celebrate that if it meant lower prices, and who wouldn't want lower prices, right? But the problem with deflation is that it can lead to it can lead to, to recessions, it can lead to layoffs, that sort of stuff. So you have to be careful. So it's a fine line to walk, the sort of maintaining the Fed funds rate at a sufficiently restrictive level long enough to bring inflation durably back to 2%, but not too long to push the economy into a downturn, a more substantial downturn. If we were to break down inflation year over year per category, it might give us insight into where things are headed. This is what headline inflation looks like. Okay, this is what we just looked at on the other screen. But now what we're going to do is we're going to break it down to see what parts of the economy are experiencing disinflation. Food and beverages, it's been coming down. And it's actually back to 2.96%, right? So it's back below 3%. It's trending in the right direction. And if you look at the monthly change, while negative, isn't as negative as it was previously, right? So the rate of change is slowing down, right? It was negative 8.5, then negative 5.9, then negative 4.9, then negative 0.4, then negative 0.366. So that's a good thing for the Fed that it's coming down, but the rate at which it's coming down is slowing down because they want to avoid this going negative. I know a lot of people here would celebrate if it went negative. I mean, who doesn't want, prices to go down? But again, there's a fine line to walk between a soft landing where inflation goes back to 2% and a hard landing where it goes back to maybe 2% or maybe even less because the Fed remained too tight for too long, too restrictive for too long. So food and beverages is coming down. And if we were to look at the monthly change 3-month moving average, you can see that it is slowing down. So we'll keep an eye on that, and we've been keeping an eye on it. And remember, last month, it was at 3.32%, so this month is down below 3%. So that one's making progress. That's good to see. Housing is sort of it's like the Achilles heel to inflation because so much of the contribution to CPI is just coming from housing. And unfortunately, housing has strong lagged effects. The problem is if the Fed is relying on some of these things to get back down, and it's, I mean, they prefer, certain ways to measure it, but if they're looking at housing and thinking that it needs to come back down to 2% before they cut, that could actually lead to a hard landing. Because look at housing. I mean, it didn't even top out. The inflation year over year didn't even top out until January 2023. Compare that to food and beverages, where it topped out in August 2022. You're talking about half a year sooner. Half a year. So the problem here with housing is that it tends to lag a lot, and it only dropped from 5.25% to 5.2% over the last month. So the monthly change is still negative, but this is still a long way from where it needs to be. I mean, you'd like to see housing all the way back down to 2% too. That's a long way to go from 5% down to 2%. Again, there's some lagged effects, and my guess is that housing inflation will continue to come down. And that's actually one of the reasons why I think that inflation year over year will come down. Because while some sectors could start to reaccelerate, inflation from the housing sector should be a headwind for inflation. That's my opinion. A couple of months ago, when we did this video, and you can go back and watch it, it was either from August or September, I mentioned that, back over here, we mentioned that it would likely bounce because some of the base effects were going to be wearing off. But that once we got out to September, it could mark a local high and it start to go down again. Now, back then, oil was moving up, right? So if you look at August and September, oil was moving up. And so a lot of people were not really of the opinion that inflation would then sort of start to fall again. But it has, right? Like it has fallen. Energy prices falling obviously has contributed. But the problem I see is that, again, with the housing sector, if the Fed goes too far, it could lead to a hard landing. So, because housing just takes so long to really catch up to the rest. Look at apparel. So if you look at apparel, it actually had a really big drop, okay? And this is something to watch because, again, this is one of those categories that was trending at 3% for a while, and then it got to 2%, which, leads to some celebrations, right? Back to 2%. Now it's at 1%, right? Now it's at 1.19%. So it's starting to drop quickly. So I think the issue for the Fed is that there are some sectors like apparel, food and beverages, right? There's some sectors where it really seems like things are slowing down, right? Like we are in the disinflationary process. It's getting back to 2%. But then you have these other sectors like housing that are probably not as bad as they seem when you just look at the data, just simply because it has a lot of lagged effects. Go to transportation. That was actually deflationary not that long ago. Now, I wouldn't pay too much attention to the deflationary trend in transportation. That's something that actually happens quite frequently with transportation. You'll find periods where it goes deflationary, and sometimes it corresponds to recessions, and there's obviously a lot of times where it doesn't. So I wouldn't put too much weight into the transportation sector. But do note that here, forget 2%. I mean, it was at negative 4.5% in June of 2023. And now it's just trending right above, right around 0.7, 0.8%. So that one is more or less in line where it needs to be. Medical care, this is one that gets all sorts of headlines because, there were a lot of people saying that it was deflationary. I don't really know. I don't really know. I don't really have any strong opinion on it. But if you do look at medical care, going all the way back to the 1970s, this is the first time that it's negative. And again, I know, there's going to be all sorts of comments saying, there's no way that's true. I'm just going based off the data. I don't really have a strong opinion on whether, how accurate this is or not, but it does at least show that it is back down to relatively low levels. Recreation. This is one that has been elevated longer than some of the other categories. You can see back in September, it was still at 4%, whereas apparel back in September was already at 2%. So recreation is one of those ones that has been lagging some of the other categories. But you can now see that it had a pretty big drop, right? So, I mean, it was at 4% in September, right around 4%. Then it dropped to 3% in October, 3.2. Now it's at 2.5. So it's dropping quickly. And if you look at a monthly change, the trend it was basically it was a bigger drop this month than it was last month. And maybe applying a 3-month moving average to it can show you that it's not slowing down. Like that trend is not slowing down just yet. So that's the hard part with all these different categories, is that like some of them seem to be already deflationary or back to 1 to 2%. Other categories are still relatively elevated. And I think that's one of the reasons why you're seeing different parts of the economy get hit at different times, right? Like some parts are getting hit, early, some parts are getting hit later. It's all sector specific. Education and communication. This is an interesting one because I've only ever seen it gone deflationary one time before, and that was back over here between 2016 and 2018. And you can see that it actually just printed negative. The last time it got close to this was back in October of 2022, but it just printed a negative print. This is a huge drop because this is from, it was at basically 0.9 to 1% for a long time. This is a big drop to go from 0.9 to 1% all the way down to negative 0.0595%. That's a pretty big drop and will contribute to the lower inflation numbers. Other goods and services. This is probably the other one besides housing that is really struggling to come back down. So just other goods and services. If we scroll down over here, you can see that it includes things like personal care products, household goods, and services such as legal and financial advice. By the way, nothing in this video is financial advice. But that's what this is covering. And you can see that this one hasn't really come down. It didn't even top out until November of 22. And last month it was at 6.2%. Now it's at 5.65. It has come down a little bit, but it's still closer to 6% than it is 5%. And it's still well above the 2% target. Well above it. So how long will it take that one to fall? History shows us that when it falls, it can drop very quickly. Look over here. In fact, over here, it saw a big drop actually in 2010. It was basically up at 7.5%. Then a month later, it was at 5%. Then a month later, it was at 2%. So when this one does drop, it could drop relatively quickly. And you might say, well, that's only because of the financial crisis. There's other times too where it was elevated like 9% and then it just dropped down to 5% and then 3%, right? So this one can drop relatively quickly when it does finally go. More examples over here. So we have all these different examples, but the one thing we have to remind ourselves is that while we have these examples, they're not all treated equally in terms of the CPI calculation. They don't just divide it evenly up and say, all right, well, they're each going to contribute X amount, okay? They're weighted differently. And if you were to go look at the inflation year over year contributions per category, so we're not just looking at the inflation per category, we're looking at the contribution to the actual metric. Let's see what we get. This is zooming all the way out. You can see what it looked like back over here in the 70s and the 80s. Look at where we are today. It's getting pretty low, right? Like it is, like some of these sectors are getting pretty low, others are lagging. Now, what's fascinating to me is that if we just hover this here, let me add on headline onto the chart. Look at headline inflation. We just said headline inflation is at 3.12%, right? So you can see 3.12%. So if you add all these other numbers up, it should theoretically come up to 3.12%. Food and beverages is contributing 0.4 of the 3.12. 0.4. And remember, the reason why that, you can go look at inflation per category. Look at food and beverages and see where it is, right? It's at around 3%. Food and beverages is contributing 0.4% of the 3%, of the 3.12%. But what do you notice on the chart that's contributing the most? It's housing. It's contributing 2.31 of the 3.12. So most of the contribution to headline inflation is just coming from the housing market, which, remember, shows lagged effects. So if you look at housing and we zoom out, it lags. It takes a long time for it to come down. Look over here. Let's compare it to food and beverages. You can see that over here, food and beverages topped out in, this is how, so food and beverages topped out in February of 74. Housing did not top out until December of 74. You see how food and beverages continued to come down, and then finally housing came down, right? So then you look at it today, and I say it's probably not going to be any different, right? Like housing will probably follow the rest of these down. And remember, it's one of the reasons why the CPI is so high. It's contributing over 2.31 of the 3.12. So that one is likely going to continue to come down, which is actually why I think inflation should come down. But I can't help but look at the 70s and remind myself that like there is a risk, right? Like there is a risk that you get something like this where it then reaccelerates back up, right? There's always a risk that it happens. Look at 1976. You know, you can see food and beverages was all the way back down here at like 1%. And then at the time, housing was still at like 6%. And then everything just started to reaccelerate again. Let's hope we avoid that. There's still a long way to go in terms of getting these durably back down to target, right? It's still a long way to go. So we'll see. We'll see if they can stay the course. And then the other contributions, I mean, apparel is only 0.03, transportation is 0.129, medical care is 0.01, recreation is 0.13, education, as we mentioned, it was deflationary, so it's actually negative on there, and other goods and services is at 0.152. So again, most of the contributions are coming from the housing sector and the food and beverages in terms of how they're weighted. So those are probably the categories that we should, focus on to see, where inflation's actually ultimately headed. We can also go look at core inflation. This one is actually still relatively elevated at 4%. And, to be completely honest, there hasn't really been a lot of progress on this in September. I mean, because in September it was at 4.1%. Then last month it was at 4.02. Now it's at 3.99. I mean, it hasn't really been making a lot of progress recently. And I mean, you can see that there's other times where it stopped making progress, right? Like here it stopped making progress around 3%, and then ultimately it just went back up. Here they stopped making progress on it at around 6%, and then ultimately it just went back up. So, we'll see if they can actually make progress on this or not. If it starts to curl back up, then it likely meant that the Fed didn't become restrictive enough. It could mean if inflation starts to go back up, it either means that the Fed's cutting too soon, or perhaps 5.5% isn't sufficiently restrictive. I mean, I think 5.5% probably is, but you also have to hold it there for a long enough period of time for it to have an effect. And if you hold it at 5.5% and inflation starts to go back up, then that would suggest that it's not sufficiently restrictive. There's no way to know. I mean, it's a theoretical idea. It's an abstract idea, right? That there exists this R star. When the Fed funds rate is above, then theoretically the economy contracts. And if the Fed funds rate is below, then theoretically the economy expands. And there's all sorts of different calculations as to what that R star is. Some people think that, the R star, the neutral rate is higher than 5.5%. Some say it's at 4% or 3%, and then we're already well into restrictive territory. There's only one way to find out is to basically see where we are in 6 to 12 months, and then we'll know more than likely if it was sufficiently restrictive. So we'll see. We'll see about that. If you look at the monthly change on core inflation, and let's just apply a moving average to it, it's generally been trending down, although again, it has been a stochastic process. So you can see a series of lower highs and lower lows. So ideally, whatever comes next is a lower high for core inflation 3-month moving average, because we really need it to drop quickly. Because I mean, this is, if it just kind of hangs out here at 4%, that's where things can get very difficult for small businesses. If look, a lot of people are thinking rate cuts are coming next year. I'm one of them. I think we're probably going to have rate cuts next year. But that goes out the window if core inflation starts to go back up. So ideally, in the coming months, we'll see core inflation drop a lot and go back to the 2% target. Because otherwise some of these businesses might just start to throw in the towel and say they can't survive higher rates for any longer. So it really is, it really is important that inflation does come down. I think we've covered what we need to. The only other thing, I mean, again, the Fed funds rate expectations right now are that the first cut doesn't occur till May of 2024. And then again, the only question is that long enough? By the way, the average amount of time, or maybe the median, let's say this, typically the Fed pauses for 8 months before they start to cut. Okay, I think it's on average about 8 months of a pause before you then come into cut. So if we were to pull up interest rates and look to see where they are right now, you can see that they hit the theoretical terminal right here in July, and then you have 1, 2, 3, 4, right? So 4 data points. It's been 4 months since then. So if we go another 4 out, that puts you in March. So on average, the Fed cuts, I think, 8 months after the terminal rate is hit. So if that's true, if this cycle represents the average, which most cycles don't represent the average, but if it were to represent the average, it would mean the Fed would start to cut in March, even though the market thinks they're not going to cut till May. But do remember, the average also includes non-inflationary cycles where the reaction function of the Fed might be different, right? So it's possible that it takes them longer to cut this time just simply because they want to make sure inflation is getting durably back to target. If they cut too soon, then what happens, right? If they cut too soon, are we just going to go into another year or two of an inflationary wave? I hope not. I really hope not. My own opinion, not that you asked, right, but my own opinion, which is often wrong, but my own opinion is that in 6 months, it's more likely that inflation is going down than going up, right? Like, so it's 6 months from today, my expectation would be that like core inflation is lower than 4%, right? So like in May of 2024, I would assume that core inflation would be less than 4%. That's my assumption. I don't see rate cuts, happening in December. I don't see rate cuts happening in January. It's possible that it happens in March, but I mean, given these inflation reports, doesn't seem to the most likely. So I would say there's still a good chance that inflation does continue to go down as long as they don't cut too soon. But I think we'll go ahead and wrap it up. Well, actually, there is the other ways we can measure it. There's the PCE price index that you can look at, and this one actually did drop a little bit here, right? It started to move up to from 3.2 to 3.4, and now it's back down to 3%. So the PCE arguably is what the Fed cares about more. This is the PPI, all commodities inflation year over year. That's actually negative, right? Negative 3.62% right now. And then we have core PCE price index inflation year over year. And that one is also dropping, right? So it was at 3.8% and 3.65. Now it's at 3.46. So that one is moving in the right direction, right? Like it is moving in the right direction. Let's just hope it can continue to do that as we close the business cycle out. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Links in the description below or the pinned comment. Thank you guys for tuning in. I'll see you next time. Bye.